Welcome to our annual State of the Markets presentation. We're delighted to have all of you here today and look forward to sharing some important information with you. Okay, today's agenda, we're going to focus on four key questions for our State of the Markets meeting. How did stocks perform in 2021? What drove market performance in 2021? And probably the most important question that is on all of your minds is, where are we now? And then we'll talk a little bit about what the financial experts are forecasting for 2022. So let's start by taking a look at Wall Street analysts' initial predictions for the market's performance in 2021, how they actually performed, and some of the factors that drove that performance. With multiple COVID-19 vaccines announced in the latter part of 2020, Wall Street analysts were cautiously optimistic about 2021. While the U.S. wasn't out of the woods at that time, there were a number of reasons to be hopeful for a strong economic recovery, including multiple vaccines to stem the spread of infections, fiscal support, monetary accommodation, and a budding reopening. As you can see from the actual results, the market performed better than even the most bullish analysts could have hoped for. For instance, JP Morgan was the most optimistic of analysts on this list, calling for about a 20% increase from the 2020 closing levels. And even that prediction ended up underestimating where the market actually closed out in 2021. So let's talk about some of the factors that led to this. After a bumpy start to the year due to the slow vaccine rollout and political uncertainty, the stock market climbed steadily higher throughout the year with a succession of better than expected quarterly profit results and a strong rebound in economic activity. However, the climb was not without its hiccups, as the rise in Delta variant infections in the third quarter, accelerating inflation, and worries over the Fed's tapering plans led to short-lived pullbacks. In the following images, we'll discuss each factor separately and in more detail. First, though, let's look how these factors affected stocks over the course of the year. As this chart shows, you see a steady move higher throughout 2021, except for some periodic dips, the worst of which was a retreat in September as concerns about the economy and Fed policy peaked. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market, but it is just an index. Keep in mind that past performance does not guarantee future results. You can't actually invest directly in an index. The return and principal value of the stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. Something that you hear me say every time. I have to keep reminding everybody about that when we talk about indexes. Without going through each of these dates, let's look at a few noteworthy points. As you can see, the market was choppy during the first quarter of 2021. Take a look at mid-March, where the U.S. crossed the mark of 100 million vaccinated Americans. At this point, the sense was beginning to grow that the nation had overcome the fits and starts in the vaccine rollout. Investors began to feel more comfortable that the country was finally getting to a place where the economy could sustain its growth momentum. There were scares throughout 2021. Look at the middle of July and more broadly the month of September. The one-day slide in July and nearly 1 month retreat in September were largely attributable to COVID-19 related events. We saw the stock market resume its climb in October based on the strength of strong corporate earnings, a decline in COVID cases, and an upbeat report from the Fed. Markets turned volatile in the close of the year, slumping on the news of the now infamous Omicron variant the day after Thanksgiving, and testimony by Fed Chair Powell that he was considering accelerating the bond taper and contemplating more rate hikes sooner than anticipated. Higher inflation and improving labor market were cited as reasons to justify accelerating monetary normalization. The markets closed out the year with the Fed announcing some decisive steps on monetary policy that may very likely impacted markets in the early part of 2022, which we'll discuss in more detail later in the presentation. Despite the pivot towards a less accommodative monetary policy, stocks climbed higher into year-end as Omicron fears receded. Corporate earnings are one of the primary determinants of stock prices over the long term. As the chart indicates, corporate profits came roaring back from their 2020 pandemic levels, lifting investor sentiment. Earnings soared in the second quarter of 2021, posting a 25% year-over-year jump in corporate profits. However, the third quarter results may have been even more impressive since the 17% growth in earnings was due during a wave of new Delta variant infections. Investors were especially impressed that the spike in infection cases did not diminish consumer demand and that companies were able to maintain their profit margins amid rising inflation and supply chain challenges. The economy staged a strong rebound in the first half of the year, as evidenced by the successive increases in GDP. However, growth moderated in the third quarter due to a rise in COVID infections and growing bottlenecks in the supply chain. While many observers anticipated a reacceleration of GDP expansion in the fourth quarter, continuing supply chain problems may prove to be a drag, and we'll get more updated numbers on that as the first quarter in 2022 continues. Labor markets were slow to benefit from the economic reopening of the first half, but as you can see, the unemployment rate dropped sharply by the end of the third quarter. As we entered into the last 3 months of the year, the labor market outlook continued to improve, with job openings exceeding the number of unemployed and robust wage growth. Inflation actually then developed as a real concern as the year progressed, rising from a modest 2.6% in March to 5.4% in September. With October and November 12-month inflation rates setting an even higher bar, I believe our last print was around 7.5% core inflation. We'll examine this development a bit more in depth later. Consumer sentiment was on an upward trajectory as well, as American consumers felt better about the economic reopening and safer with the rollout of the effective vaccine. However, it flagged amid a surge in Delta variant infections at the start of the second half of the year. Fourth quarter numbers actual sentiment reading for November reflects a continued downward slope in consumer outlook due to rising inflation and the perception that policies have not been put in place to arrest the rise in prices. Finally, home builders' optimism was especially high in 2021. Not surprising given the low interest rate environment and the continued consumer demand for homes amid the pandemic. The number indicated is a survey of single-family home builders, their view of the current conditions, and their 6-month outlook. Scoring on the basis of 0 to 100, you can see how high their optimism was throughout the year, notwithstanding a dip in third quarter, owing to that quarter's resurgence of COVID cases. So we looked at some factors affecting market performance in 2021. Next, let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2022. To create some context about where we stand today on various factors, let's start by examining where we stood just before the pandemic began. After a stretch of good economic performance, conditions in February 2020 were mixed, though still positive. You can see a number of positive indicators, including monetary policy, consumer spending, interest rates, and perhaps most notably, inflation and energy. There were some cautionary signs about the future, such as the economic outlook, equity valuations, leading economic indexes, and corporate profit growth. The only two factors of concern were really geopolitical risk and the domestic political environment at the time. Now let's fast forward to November 2020. By then, we appear to be beyond the worst days of the economic lockdowns and COVID cases. The overall outlook was cautious. While monetary policy, inflation, corporate profit growth, and leading economic indexes were trending positive, there were more cautionary signals, most significantly in consumer spending, energy costs, business sentiment, and labor market weakness. There was also the double of the number of negative indicators from February, most notably equity valuations and disposable personal income. Now let's review what these financial and economic indicators tell us today in today's current state. As you can see, 17 of the 20 indicators as of December 2021 are green, which suggests that the economy and markets are in good position for 2022. Only 3 are flashing some warning signals, such as equity market valuations. After the run-up in values in 2021, this shouldn't come as too much of a surprise. There are no outright negative indicators. Now, what I will say is we've been working on this presentation for a few weeks now, putting the data together, and I can tell you in the first 8 weeks since December, quite a bit has changed. I mean, we're really looking at things like inflation, monetary policy, interest rates, of course, energy costs, and consumer sentiment. We'll talk a little bit about those going forward. Now let's dive a little deeper into the speedometers, particularly the leading economic index, or the LEI. This includes 10 components ranging from stock prices to manufacturing orders. When examined together, this data may give a clearer view of where we are. Leading economic indicators suggest that economic expansion is trending higher into 2022. Though supply chain bottlenecks cannot be overlooked as a factor that may frustrate this outlook, as you can see, a rise in the index of leading economic indicators has never been followed by a recession. So that's at least one encouraging sign. However, no model is flawless, especially with COVID still hanging over global economies, particularly bottlenecks in China and a zero COVID policy there. Still a lot of uncertainties out there in terms of the economic indicators. Now let's look at some headwinds. From the leading economic indicators and economic speedometers, we just saw that the economic outlook is looking positive overall for 2022. However, the economy and the financial markets will have to withstand some potential headwinds to meet these optimistic expectations. The first headwind is obviously Omicron, which I think we can say now it was a pretty big scare, but it's mostly subsiding. Well, few expect the sort of economic shutdown now that happened in 2020, given the progress of vaccinations. Any future moves to restrict social contact may adversely impact economic growth in the future. Now, the big thing is inflation remains a very, very big challenge for the economy. As higher prices start to sap consumer spending and consumer confidence. We're going to take a deeper dive into inflation's implications for markets later in this presentation. We'll also see rising yields as bond investors look for higher yields to compensate for rising costs. At the end of the year, the Fed announced that it would be quickening the pace of its wind down of its monthly bond purchases and signaled that as many as 3 rate hikes might follow in 2022. Now, the first one's supposed to be set in March, and the big talk now has been whether is that a half percentage point rate hike or just a quarter point. Right now, the hawkish sentiment seems to be indicating maybe a 50 basis point or a half percentage point increase will be likely. So this is obviously having a major impact on how the stock market is behaving. Fed is clearly looking to return to more normalized monetary policy amid a healthy economy, a rebounding labor market, and accelerating inflation. Now, it's uncertain how investors will react as interest rates move higher, but obviously we've seen in the first few months is there has been a sell-off, and we're going to talk a little bit more about that in looking at this issue of inflation and rate hikes. But if the Fed finds itself behind the curve in fighting inflation, it might be forced to actually put on the monetary brakes a little bit harder, which could actually adversely impact markets further than they already have in the first few weeks. As 2021 came to a close, there were early indications of slowing economic growth in China, in large part due to its zero COVID policy that shut down whole cities at the first report of infections. In fact, this is still going on. As its wealth has grown, China has become an increasingly larger importer of foreign consumer goods and raw materials. Any reduction in demand will be a drag on a wide range of companies globally. So that's something that we got to keep an eye out on. Finally, geopolitical tensions are always a potential headwind. And now, obviously, the elephant in the room here is Russia's invasion of Ukraine and the bombing of Kiev and some other cities. I don't want to downplay this. This is a very, very serious situation, and the geopolitical tensions are heightened. We opened up this morning, and markets opened up significantly down, only to see as of midday, the last time I checked a few minutes ago, markets had already come back. NASDAQ was in positive territory, and I believe the S&P had just breached positive territory as well. So there was some really deep discounting on the news. But in fact, when it actually came out and the invasion started, we saw a correction and the market clawing its way back from those losses. I want to say one quick thing, and I'm going a little bit off script here about that situation. So Russia and Ukraine do not represent major portions of the global economy. They're primarily commodity-driven countries. Russia, primarily oil. It gets the bulk, the lion's share of its revenue comes from selling energy products, oil and gas. Ukraine, a little less so, but it's also a breadbasket, and it gets a lot of its GDP growth from wheat. So those two countries, from a, if they go to war from a capital destruction point of view, it's going to be minimal, right? And what it consumes, they're not big consumer countries. They do have imports, but it's not going to impact companies globally. So what the knock-on effect is really what we're looking at is, what is the impact on oil and gas prices, and what's the impact on wheat? Both of them are up strongly. So that the wheat prices, especially if there's a sanction, which Western countries, namely Europe, stop buying wheat or oil, what that does, right? So what that does to their economies. And with Russia, I think this is a long-term negative, as is shown by the stock market. They had a 45% decrease in their stock market value, the worst ever in its history, and probably one of the worst clocked in any time in history for any market. So the market is not very positive about this development. I want to downplay things a little bit, because while the impact on oil and gas and wheat prices is inflationary, right? As prices go up, that causes inflation to rise. It's only part of the larger problem that the pandemic caused in the supply chain issues. And we're going to delve into that in a little bit, but I want to bring that out. It's significant, but it's not that significant. I mean, it's marginal in its influence, and it is a negative, but it's not huge. Much bigger is the global supply chain problem. I'm going to talk a little bit about that more. Now, let's shift to the positive and talk a little bit about the tailwinds. So the economy is in really good health. The overall economy, especially the U.S. economy, is expected to expand in 2022. Now, the level at which economic growth serves to propel markets higher, of course, will be the function of how healthy that growth is. Though the Fed is reducing its monthly bond purchases, they're not expected to end it until June or July. Moreover, the Fed has indicated that any rate hikes will likely be in the second half of the year, though there's a lot of, actually, the Fed came out and it appears that they're signaling a March rate hike. So they've advanced the rate hike somewhat. Now you're hearing in the markets, 7 to 8 rate hikes would take, short-term lending to banks upwards of, 2 percentage points. I don't think that's going to happen. I don't think we really have the capacity to do that. And you can see that I could talk a little bit more about that later, but you see that in the bond market. The bond market is not indicating that we're going to have sustainable inflation. So as much as there's a lot of talk on Wall Street and the pundits that you guys read in your news feed, I'm still of the opinion that a modest rate hike this year is in order, and probably some scaling back of bond purchases and lowering the quantitative easing, and maybe going to a quantitative neutral state. Corporate profits in 2021 were solid, and so far, the corporate profits are still growing. Maybe not as much from the pandemic bottom, but they're still growing pretty strongly. So as mentioned, obviously corporate earnings are the most important impact on stock market valuations. And so when we look at the sell-off in the first half of the year, most of that sell-off is occurring in growth stocks. Why? Because growth stocks rely on future earnings. Their valuations are heavily dependent on earnings 5, 6, 7, 8, 10 years out. So when you look at those earnings and you're discounting them back to the present, if we have higher rates, those earnings are not going to be as valuable. So this is why the growth stocks are really taking a beating versus, say, value stocks. Now, bond markets have also been taking a little bit of a hit on the chin, but not by much. Bond markets in general have been outperforming. So bonds have been doing what they're supposed to be doing by regulating the volatility of stock markets. It's not good that they're falling off, but they're still doing what they're doing. Also, the consumer still appears to be pretty healthy. As net worth has grown from pre-pandemic levels, financially strong consumers should continue to support further consumer demand for goods and services. And I'm going to get a little bit more into that. So consumer confidence is ebbing a little bit. So we want to keep an eye on it. It's still positive, but it's ebbing in the face of this rising inflation. And I'm going to talk about that coming up. So before we move into a little bit of the inflation forecast and things like that, let's examine this chart of equity values to see where stock prices are trending against historical averages. The most common way to do this is to look at price earnings ratios, what we call PE, which measures what investors are willing to pay for a company's earnings. If you look at the dotted line in the middle, you can see that the PE for the last 25 years is on average about 16.8. Let's call it 17. You can also see that the PE will move around quite a bit, with peaks during the dot-com boom and the trough during the great financial recession. As of October 2021, the PE was about 21.4, which is higher than its 25-year average. It may bear mentioning, as I already did, that the big technology stocks, which because of their growth prospects typically sport higher PEs, represent a greater proportion of the S&P 500 than ever. So a comparison to the past actually might have limited value. When you go back to the dot-com, a lot of those early technology stocks, including Microsoft and some of the others, they were still in sort of growth phases that were much different than they are today. And then now these companies have matured and they're paying dividends, which they didn't do back in the dot-com era. So you have to be careful about some of these comparisons. So obviously higher rates also are reflected in lower interest rate environment that we've been enjoying the last decade. So one of the big scares, like I mentioned earlier, higher rates may lead to lower valuations. That's also weighing on the stock market this early part of 2022. So now let's move on to some of our forecasts. So we mentioned that a healthy consumer might be a tailwind for the market this year. Here's why we think this is the case. The share of GDP that comes from spending from within the US is just a shade under 70%, which makes the financial health of the American consumer integral to economic growth. This chart is an illustration of where Americans' balance sheets are coming from in the new year. As you can see, assets owned by individuals have steadily risen since the depths of the pandemic in the second quarter of 2020 to a level that is now higher than pre-pandemic levels. Meanwhile, consumer debt has stayed roughly the same through the same period, owing in part to the government assistance programs throughout the pandemic period. When taken together, Americans' net worth has increased, which has put more spending power into the hands of consumers, which may lead to higher economic activity. And not may lead, it has, in fact. So, in fact, we've seen a lot of growth in spending. And then this is in part one of the reasons why, and I'm going to get into it in a minute, of why we have the inflation that we have right now. So, confidence in the future still seems pretty high. In the past 2 years, we've seen that consumers who lack confidence in the near-term health of the economy or are concerned about the spread of COVID infections are less likely to spend. Consumer confidence took a big hit in 2021 as it came to the close, thanks to that Delta surge, but we've been accelerating out of it. And in turn, we've been seeing accelerating inflation as well. Now, taking a look at corporate earnings. Corporate earnings will be another likely important determinant of stock market performance in 2022. After all, these are the key factor determining stock valuations in the long run. As I mentioned, 2020 earnings were strong, rebounding strongly from muted earnings during the pandemic. As you can see from the chart, the third quarter was exceptionally strong, increasing 39.8%. Fourth quarter earnings, which are still kind of rolling out as companies report January, February, we'll get a better picture of this by the end of March, but they're expected to come over 20%. So these are big numbers, and they're probably not going to be repeated. From what we read right now and the research that we're seeing, they're expecting corporate earnings growth to be around 9%. So part of the issue that we had going into this first quarter and the pressure on the stock market is that in order to justify the lofty valuations that we saw growing in the first or the latter half of last year, it's not good enough just to meet expectations. You kind of have to beat them. And while a lot of companies are meeting the expectations, when the analysts are reading in between the lines, there's cause for some concern, especially in the growth rates of the highly valued technology sector. So we're seeing a bit of a pullback on valuations in the market for growth, which is driven by the earnings, but also the fact that we have rising rates, which are discounting those earnings even more. And so it's a little bit of a 1-2 punch for growth stocks. And we've seen a big sell-off in the first half of the year. Doesn't mean that we're going to start selling growth in the portfolio. Growth is still a very important long-term position. It just means that we're seeing some rotation right now out of growth into value. And our portfolios that we've created for you are pretty broadly diversified and have a significant investment in healthy dividend-paying stocks that are classically considered value stocks. I want to move on to inflation now. This has been the talk of the town. You see it every day. Everybody's talking about it. It's an important economic indicator. Rising prices impact the entire economy. Too much inflation actually can hinder growth, while too little inflation can actually be a sign of economic weakness. Right now, we obviously have some very high inflation prints. Inflation took a sharp turn higher last year from the norms of recent decades. Strong rebound from the pandemic-induced recession, coupled with labor shortage and supply chain bottlenecks, caused the price of many goods and services to jump. Some economists also point to the combination of fiscal spending and accommodative monetary policy as contributing factors to the acceleration of inflation. And I think there's definitely a lot of truth to that. Inflation has accelerated at a faster pace and persisted for much longer than originally anticipated by the Federal Reserve. Fed Chair Powell has admitted as much. Despite this admission, Powell still believes inflation will recede in 2022. The markets have largely accepted this inflation narrative. Now, we've seen the markets pull back, but when we talk about markets, we're also talking about the bond market. And the bond markets have, in fact, not budged. They have not really changed that much. I mean, they're selling off a little bit to accommodate small increases in rates, but it's not, long-term bond yields are not priced, do not seem to be pricing in 4 or 5% sustained inflation rates. So if we look at it, we extrapolate, we're probably looking at inflation somewhere between the 2.5 and 3% basis over the midterm, so say 5 to 10 years. And we'll see if that's even sustainable itself. But inflation is having right now a major influence on the performance of the financial markets, since it's forcing the Fed to quicken the pace of its bond tapering program and change its plans for interest rates. In each instance, the Fed's actions are impacting bond yields and stock prices. So as the speculation continues, so does the speculation about the values of stocks and bonds. Even if the Fed sticks to its schedule for tapering and interest rate hikes, the bond market and the stock market may not sit idly by. In fact, the bond markets have been selling off, and we haven't even seen a rate hike yet. So you can see that the market's anticipating some of these moves. Bond investors may, in the end, require higher yields to offset rising inflation, and that's going to have a ripple effect back through the stock market for sure, and especially for those companies with high valuations. Now, I want to talk a little bit about why we've been seeing inflation. Here is a chart that's really important to understand. You see here over the last few years up through 2021 that on the left-hand side you see goods spendings, goods, so not services, but goods on products, right? And you can see that it spiked significantly, well beyond the trend, the norm, right? This pandemic has led to shifts in consumer preferences for goods at the expense of services, which you can see on the right-hand side. Services spending, think airlines, buying a ticket somewhere, or going to an event, or something that required interaction with people. That all collapsed with the pandemic. Now you're starting to see this close. So we should expect some normalization in a drop-off in goods spending, effect of reducing inflation, right, in favor of services. Because most of the CPI is not services. Most of it's still goods, right? Core inflation is a basket of goods that we purchase. And so that's what we're seeing. We're seeing a consumption. I listened to a very interesting talk yesterday about a drinks group CEO, and she was saying how drinks purchases of mixed cocktails and premium distilled liquors was going through the roof, and that was mainly due to the pandemic. And the question was asked, well, what happens when we reopen? Do people start going back to restaurants and bars? Her counter was, oh, well, they're going to want to demand higher quality drinks. I'm not so sure of that. I think you'll probably just see people buying less, probably going out, doing things more, and not sitting at home drinking, watching the news. So I'm not convinced that the sustained prices in goods is going to hold itself, and I think that we're going to see some reversal. You can see this on the left-hand side, goods versus services. You can actually see it compared, right? So the light blue is the services consumption, and the dark blue is the goods. See the dark goods in the pandemic, it spikes up, the services go down. We're going to see that trend normalize. If I drew a red line, a trend line in these, you'd see that there's a long way to go. On the other side is also a very important chart, and that is the manufacturing in the light blue, the delivery times, and the dark blue is capacity utilization. You saw as capacity went up, as goods demand went up, capacity utilization went up. It was hard delivering the goods, so goods delivery times took longer and longer. So that is what we call a bottleneck, and that's causing inflation. As the pandemic recedes, and it will recede, it's going to go away. We're going to see inflation taper off significantly, and all the bearish pundits out there that claim we're going to have 5 to 7% inflation rate sustainable going forward, in my opinion, there's not a basis for that. And the reason why I am confident in that is because if in fact that was the case, you would see long-term bond yields going through the roof, and they're not. And that's because even the bond market, and that, as we say in investing, the people who put their money where their mouth is, they don't believe it. And I don't believe it either. And I think we're going to see inflation come back down to the 2.5%, 3% level going forward. Here's another little chart on inflation. You can see what's interesting about it is that most of the purchases, or most of the inflation is coming from purchases of used cars. It's one of the biggest drivers of this. It's an interesting factoid, and it's not actually as broad-based as people think. So, but it's still mostly the inflation is 90% of the growth in goods consumption since the onset of the pandemic has actually come mainly from the US. And we haven't even seen this trend worldwide. So I feel that the case for long-term higher inflation is pretty much a moot point. We're obviously going to see higher prints going forward, but we're gradually going to see this fade away. Now, about one of the reactions to the inflation is actually higher rates. So when I say rates, I mean central bank rates, not just in the United States with the Fed, but also the ECB in Europe. Everybody's talking about higher rates. So this chart is interesting. It looks at the change in price before and after the Fed rate hike. As you can see, for the most part, in the last several rate hikes, S&P 500 was positive as we go into the rate hike. And the first 3 months after is negative. But you see, as you go further and further out, that we see a positive performance in the market. In fact, I don't have this chart today, but I've shown it to you guys many times. We don't start to see a negative drag on stock market performance until the 10-year Treasury breaks 5%. And we're a long way off from that. We barely got to 2% the other day. And as of yesterday, it dropped back down to 1.88%. So we're far away from what we consider historically a drag on equity performance. Now, having said that, if you're observant, you're going to say, Daniel, well, we haven't got a rate hike yet. We're 1 month away if they're doing it in March, and we're down significantly in the stock market. And that would be a very good observation. So the market is anticipating the rate hike to be much more quick and severe, and which is why we're seeing the market respond so negatively. In these past rate hikes, we didn't have the same situation where we went from having negative inflation in the pandemic to 7.5%. So there's a little bit of a whipsaw effect going on, and this is why I think this chart's only instructive by so much, because we are coming off of sort of an unprecedented thing, which is a global lockdown of the economy that's never been done in human history before, coordinated government shutdown of the economy, creating all these bottlenecks, and then the subsequent inflation that we see because of that. I think that it's so impactful what happened with the lockdowns that we'll be writing about this for decades to come, probably talking about how poor of a choice it really was and how we managed it. That's my economist hat speaking right now. I think they're going to look back and say that probably wasn't the best option. But going forward, we'll see if future pandemics, I think with the mRNA technology, we're probably going to see much more rapid development of vaccines and things like that. But I do not think that in the next pandemic, we're going to be able to spend the equivalent of $7 trillion in aid. So what we're seeing is a little bit of a whipsaw effect, but I do think that the rule is going to hold. Going forward in the next 18 months, there's a good chance that we're going to see stock market increases going forward. Here's another chart we need to take a look at. You look at real GDP. The economic forecasters surveyed by the Philadelphia Fed are painting a generally improving economy. Now, while they have trimmed their GDP growth estimates for the final quarter of 2021 and the first quarter of 2022, they're projecting stronger growth in the second half of 2022 than originally anticipated. On the labor front, they're very optimistic, calling for declining unemployment rates through the year and at a much faster pace than had been previously predicted. Now, this is giving way to a little bit of wage growth, which we're going to talk about next. The labor market continued to strengthen over the course of 2021, with unemployment falling and wage growth accelerating, as we saw in the previous slide. Unemployment is expected to fall further. A healthy unemployment picture has historically augured very well for the economy. Increased wages means a faster velocity of money, which means more spending, which means more earnings growth. And so far, that's proven to be true. Companies have been able to pass through higher wage costs in the form of higher prices. Now, that's obviously one of the worrying signs is, where does this thing settle? Is this going to be sort of a one-off wage correction and increase in wages, or is this going to be a long-term sustainable thing that where wage and inflation is clocking well above GDP growth? So while wage growth is generally a positive development for the economy, it should be noted that the upswing in wages has been offset by a faster rise in prices, leaving many workers with lower spending power. This is the flip side of the coin. We're already seeing signs of lower savings rates. That savings rates that we saw during the pandemic have largely fallen off. And now even though wages are growing maybe like 5%, if we keep seeing 7% inflation prints, that means wages are not going to be keeping up with inflation, and that can potentially augur a pullback in spending. And so that's something that we have to keep an eye on going forward. So let's take a quick look at the forecasts by the big financial firms for 2022. On average, they're expecting a modest gain in 2021 from the 2021 close. The forecast reflects the belief that stocks are unlikely to repeat their outsized gains of 2021, as well as some headwinds that may impact corporate earnings and economic growth, particularly inflation and the supply chain disruptions that I've already talked about. Within this average forecast for modest returns is a broad range of estimates, from a flat or slight decline to a much healthier gain. Of course, we don't know exactly how this ends. Usually predictions are only so useful, and because they're just predictions. However, these analysts' perspectives show that, for the most part, Wall Street still is generally guardedly optimistic about growth. In fact, if you look at I was looking at this morning, the S&P 500, if the group average is correct, it's actually a 16% growth from yesterday. So that's a pretty significant climb. Obviously, we've seen that the reason why it's 16% now is because we've fallen off in the first 8 weeks. So we've covered a lot of information here, focusing most of our discussion on what drove the market and what we expect to move the market over the short period of time. However, as we know, what can sometimes get lost with a short-term focus on the market is a consideration of the long term. This chart illustrates the value of investment discipline. Since 1950, we can see that the one-year range of returns for stocks is quite wide, with yearly gains of up and down to 47% and yearly losses of up to 39%. As represented by the purple bar, bonds have a much narrower performance, ranging from plus 43 to minus 8. Finally, we see a hypothetical balanced portfolio of 50% stocks and bonds, in which with their lower highs and higher lows. If we follow the performance of these three portfolios during the 5, 10, and 20-year rolling periods since 1950, we see that the range of return narrows. In short, a balanced portfolio can help manage overall risk. The precise allocation among different asset classes will vary from one investor to another, depending on their individual goals, time horizon, and risk tolerance. Asset allocation is an approach to help manage investment risk, and that's one of our primary focuses at Advanced Portfolio Strategies is that key asset allocation. It doesn't guarantee against investment loss, but it can reduce volatility and reduce risk. So steps for you to take for 2022 as we move closer to your goals. If your life or personal situation changes, please keep us in the loop. We want to hear about important family events like births and deaths and things like that. We also care about health issues, employment changes, and any financial developments that may change your situation. If you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like a shift in your risk tolerance or any concerns about the market environment. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure they're all up to date. A well-organized estate is one of the best gifts you can give to you and your family. So we're here to talk about whatever financial questions that you have. I want to move forward quickly into questions because I've taken a little bit longer than normal. So are there any questions?
I just had a question about China. I have heard stories that China's economy is got a challenge with its real estate sector with defaults among some development companies. I was wondering if that's going to spill over internationally over to the United States economy.
Short answer to that is yes. So China's economy, depending on who you talk to, it's either the first or second largest economy in the world, and they are increasing, importing more. So any kind of financial crisis there that would disrupt their capital markets would potentially disrupt their investments and their consumption, and so could have an impact on slowing the global economy. In fact, it has been. China's printing some of the lowest growth rates it's had in decades. In large part is because in the property market, there are a tremendous amount of investments in basically underperforming properties. And when I mean underperforming, building buildings that nobody wants to use. And that is finally coming to a head. There's a reckoning going on in China, as you can see in some of the news about, the defaults on some of this private debt by some of these development companies. So that's affecting China's overall economic growth. So what's interesting about this is that as we're about ready to raise rates, trying to temper the growth and particularly inflation, China is actually easing on its monetary policy in order to stimulate growth. And so going forward, that could have a significant tailwind into the economy, not probably this year, but 2023 and 2024, if their monetary easing and their efforts to stimulate the economy actually prove fruitful. Is the general idea that we will have a pullback in markets after interest rate increases, slowing earnings and slowing consumer spending? So the markets are forward-looking. So the markets are responding to the slowing of consumption based upon a few things. One is that wages are not keeping up with prices, right? So that's inflation. That would have a dampening effect. The other effect would be the rising costs of financing or capital. So as rates go up, borrowing costs go up. In particular, we've already seen mortgage rates go from around a 2.7% on the 30-year mortgage, fully amortized mortgage, about 2.7%, and it's all the way up to 3.8. So we've seen a significant increase in the financing costs. Because of the low supply of housing, it doesn't have seemed to dampen the demand for housing, but certainly the costs are going up. So as housing costs, the finance housing goes up, or the consumer financing costs go up in the form of higher borrowing rates, that will certainly be a headwind to consumption. And so, in part, that's why they're raising rates, is to sort of slow it down. It's tapping the brakes. The million-dollar question is, will the Fed engineer a soft landing, or will they break too hard and send us to a recession? And I think that's what you're seeing the markets try to figure out. Is it going to be a soft landing? Are we just going to go into this smooth landing as the economy slows, or are we bouncing off the ground and with a big jolt and causing a bunch of headaches in the economy? So that's what I think is what's happening, and that's why you're seeing the volatility that you're seeing today. Great question. I think that the people are starting to leave now, so I think we're gonna get off this call, and I'm gonna encourage everybody to reach out to Glenn or myself to follow up any questions you have about this. Hopefully, it's been informative, and we'd like to talk to you about your personal portfolios. So please feel free to give us a call or set up a meeting, send us an email, and we'll take it from there. We'll also be sending out a recording of this, so if you want to go back and hit any of the highlights, you can. Thank you all for joining, and we'll see you next time.